Welcome, everyone. Thank you so much for joining us today. I'm Joan Hull, the Director of Relationship Management for CanAm Enterprises, and I'm delighted to moderate this very special session with Sheela Kulkarni, the Head of Market Development and Institutional Relationship Management at the World Gold Council. As we are experiencing increasingly volatile and uncertain economic times, gold has been an asset class that so many investors are looking to provide stability in their portfolio. And we are excited to be able to hear directly from the World Gold Council, the experts, about what they're seeing in the market, where they're seeing demand, their thoughts on gold's role as a strategic asset class in a portfolio. And without further ado, Sheela, I'm going to turn things over to you.
Thank you. Thanks, Joan. Thanks for inviting me. And I do hope, investors start looking at gold as a strategic asset once they heard this presentation. So without much ado, the World Gold Council is a membership-driven organization, and we champion the role that gold plays as a strategic asset. We have a team of experts who build the understanding on the use case and the possibilities of gold through trusted research, analysis, commentary, and insights. We also drive industry progress by helping shape policy, setting the standards for a perpetual and sustainable gold market. Now, we've seen both last year and for a certain amount of time this year when gold kept going high and high. Last year, gold crossed 40 new highs, and this year was no different until April, when actually it touched $3,500 per ounce. So we have to see, where it goes from here. But gold has been one of the best performing asset classes, at least in most markets globally. And, this performance that we saw in gold was across all currencies. So not just limited to US or India and China, where the maximum demand comes from, but literally in all other currencies as well. Now, what we do is we produce a report on a quarterly basis called the Gold Demand Trend Report. And we track demand coming from various places, whether it's jewelry, investment, central banks, or technology. And we also track supply coming from gold mines or through recycling. And if you look at the Q1 2025 gold demand trends, the total demand was approximately 1% higher year on year at about 1,206 tons. But what we saw was gold ETFs actually had the highest quarterly inflows since Q1 of 2022 at 227 tons. Central banks, who have been consistent buyers of gold over the last 3 years, also purchased gold this year in quarter, amounting to about 244 tons. Bars and coin, the demand remained elevated at 325 tons. Jewelry, on the other hand, was much lower, quarter on quarter and year on year at 380 tons. But this was expected because of the higher prices, where a lot of people refrained from buying jewelry or bought lower caratage. Technology demand was quite supported at 80 tons. It could have been higher if not for, the tariff wars that we saw starting from November of last year. Mine production inched to a new record at about 56 tons. And recycling, on the other hand, which we expected to be high because of high prices, surprisingly fell. If you look at how this demand has actually panned out, as I mentioned earlier, record prices subdued jewelry demand. India and China, which are the largest consumers of gold, and most of it is in the form of jewelry, saw the highest drop. So, for example, the Indian demand in Q1 was just about 71 tons, a 25% drop in demand. And in China, it was just about 125 tons, over 30% drop in demand. Um, obviously prices have dented jewelry consumption in countries like India and China. And value-wise, we've seen actually a jump, but volume-wise, definitely much lower. On the other hand, what we saw in Q1 was a broad-based surge in ETF inflows. Until last year, we saw that a few countries, especially in the European region, not really buying into ETFs. But we are seeing that demand come again this year, at least in Q1. And overall, ETF demand was quite significant at about 226 tons. At least in Q1. Central banks, like I mentioned, have been consistent buyers for the last few years. In Q1, the largest purchases were reported from Poland, which bought about Central Bank of Poland, when they actually purchased about 49 tons. We also had the State Oil Fund of Azerbaijan, China, Kazakhstan, Turkey, and India up their purchases. Overall, we've seen in the last 3 years, central banks have been buying gold close to 1,000 tons each year. And we expect the trend to continue this year as well. Now, we all know that gold is a global market. Having said this, majority of the demand comes from the emerging markets. India and China alone account for 50% of the global demand. And the developed market demand is just about 29%. What drives gold demand? We've been able to categorize demand into two buckets, strategic and tactical. And within strategic, we've seen that the drivers for demand are periods of economic expansion, which are especially supportive for jewelry demand, technology demand, and long-term savings. Periods of risk and uncertainty also often boost investment demand for gold as a safe haven. What we've seen in the last few years, whether it was the Russia-Ukraine crisis or the Israel-Hamas invasion, these periods have been very supportive for gold. As the equity markets turn very volatile, investors turn to gold clearly for its role as a safe haven. On the tactical side, opportunity cost is a big driver for demand, whether it's through interest rates or competing assets such as currencies. These assets influence attitudes towards gold. Momentum is another factor that drives demand. So whether it's price trends, capital flows, and positioning, which could ignite or dampen the gold's performance. Mm-hmm. Now, gold has a dual nature. It's probably the only asset class that is used not just for investment, but also for consumption. The average net annual demand for gold is in the range of 3,128 tons. 33% of this demand is for jewelry, 40% is investment-led demand. Central banks account for about 20% of this annual demand, and technology accounts for 7%. If you look at Indian demand, we all know that Indians love gold, especially jewelry. And on an average, our purchases have been in the range of 750 to 800 tons for the past 8 years. But what really drives Indian demand? We've been able to do an economic analysis, and we've seen that in the long run, income becomes a big driver for demand. For every 1% increase in income, the demand for gold actually goes up by 0.9%. However, gold price dampens demand. So every time the gold prices go up by 1%, the demand for gold actually goes down by 0.4%. In the short run, inflation is a driver for demand. So for every 1% increase in inflation, the demand for gold also goes up by 2.7%. And if you look at monsoons, the Indian economy is largely agriculture driven. And we've seen that for every 1% excess rainfall over the long period average, the demand for gold again goes up by 0.1%. Prices, of course, influence the demand for gold. So in the short run, we've seen that prices go down by 1.2% when when the price actually goes up by 1%. Taxes are a big influencer for the demand for gold in India. So when the government actually increases duties, customs duties or import duties as they are called, uh, the demand goes down. And we've seen that for every higher rate of customs duties, the demand has been depressed by 1.4%. Last year was an aberration. The government for the first time actually reduced import duties by 9%, and we saw investors jumping because the prices corrected and the demand actually went up. So like I said earlier, Indians love gold. We keep buying gold right from the time a child is born till they grow old. We have various occasions, birthdays, anniversaries, weddings, and we also have festivals where people consider it auspicious to buy gold. So we have one festival during Diwali and another festival which has just actually happened in the month of April called Akshaya Tritiya. These are two occasions where, what are the festivals when it's considered to buy gold, and a lot of people that you end up buying gold. And weddings, of course, may not be complete. It's not just the bride and the groom, but the extended family also are seen very important. So 80% of our demand in India is in the form of jewelry. The remaining 20% is bars, coins, and ETFs. So what is the strategic case for gold? Why should one have gold in a portfolio? Let's see if gold can actually provide returns. Is it a good diversifier? And is it really a liquid asset? So in terms of returns, we did an analysis of gold, and we compared it with Indian stocks, Indian bonds, government bonds, and corporate bonds, and T-bills. And we did this analysis from 1 year to a 15-year time frame. And we've seen that on an average, gold gives you anywhere between 10 to 12, going up to 20% return, like it happened last year. And therefore, it actually is comparable. If you look at equities, bonds, it does get good returns. Now, if you look at periods of high inflation, we've seen that gold historically performs well in periods of high inflation, and it has also kept up with money supply growth. When inflation actually reduces your purchasing power, or there is a debasement of currencies because of excessive money supply, we've seen that gold is one asset class that actually performs well. If you look at a portfolio construct, you also need an asset class that's not volatile. And we did a comparison of gold with various asset classes such as emerging market stocks, US stocks, REITs, private equity, crude oil. And if you look at the volatility, apart from bonds, gold is definitely less volatile than the other asset classes. And therefore, we think that an investor should allocate some amount of their portfolio to gold. If you look at diversification, good diversifiers are hard to find. What you need for a diversifier is actually not just do well when the markets do well, but to actually cushion your portfolio when everything else is falling apart. And if you look at gold, we've seen that when equity markets do well, gold also does well. But when equity markets fall, gold actually does better. So it is indeed a very good diversifier. We've also seen the same correlation with bonds. For the past few years, the correlation between equities and bonds has turned positive. But the correlation between bonds and gold in falling markets turns negative. And therefore, a diversifier like gold can actually ensure that you get good risk-adjusted returns when these two major asset classes are falling down or are very volatile. Now, if you look at gold from a diversification perspective, we've done an analysis right from the 90s going up to the Gulf War or Brexit, the Russian invasion crisis of 2022, or the Israel-Hamas crisis that we saw a couple of years ago. In all these periods, the price of gold we've seen increases. So after every geopolitical event, a major geopolitical event, uh, the price of gold tends to increase versus equity asset classes like equities or bonds. Similarly, like in periods of systemic risk, we've seen that gold prices tend to go down. So from a diversification perspective, what we've seen is the price of gold tends to increase in terms of systemic risk. We've looked at the mid-90s when there was the FECM crisis, the dot-com bubble, the sovereign debt crisis, Brexit, COVID, and the period after COVID pullback. And in all these periods, we've seen that gold actually does well in comparison to global stocks or US treasuries. From a liquidity perspective, the amount of gold that gets traded every day is over $200 billion. It's definitely more liquid than Indian bonds, Indian equities, or even US T-bills. And I don't think there is any other asset class that's traded so much, not just through ETFs, bars and points, or through the futures markets, comics, or OTC markets. So it's one of the most liquid asset classes that we have. From a portfolio perspective, I think it's important to understand not just the opportunities, but also key risks. Gold doesn't conform to the most traditional valuation methodologies that we use for equities and bonds. A perceived drawback for gold is that it does not provide any regular income, whether it's through dividends or interest rates. But gold is a great diversifier because it behaves very differently to equities and bonds, and not just because it has a low volatility. From a portfolio impact and optimization perspective, what we did was we created a hypothetical portfolio with 70% equities and 30% in fixed income products. And we started adding gold ranging from 7.5% to 15%. And we saw that the risk-adjusted returns of this hypothetical portfolio with gold was much better. Why? Because it actually reduces volatility in the portfolio. The reward to risk is much higher and the maximum drawdowns are lower. So the annualized returns in a portfolio with gold are much higher, and we think going up to 15% is optimal. How does one invest in a market like this? It's important to understand what is the size of the investment and how frequently you would like to rebalance your investment. Also, what's the operational consideration? If you would like to have the touch and feel of the product, would you need physical delivery? Then of course it would be bars and points. But if it's a long-term strategic position, then you have products such as gold-backed exchange-traded funds. And what you also have for those investors who don't have an electronic or a demat account is a wrapper called the gold fund of fund or gold saving funds, which actually subscribe to gold ETFs. We also have a third asset class, which has become very popular in the past 3 years, called the multi-asset funds, where the regulations mandate that the minimum allocation to a precious commodity like gold or silver needs to be 10%. Some funds even have a maximum allocation going up to 25%. But these 3 categories are the most popular categories if you have to invest in gold-backed products. They're regulated, and you can start with really small quantities, and there is no upward limit in terms of how much you can invest. Having said this, if you look at the recent performance and outlook, like I mentioned, gold outperformed most asset classes in 2024. In terms of returns, giving returns in excess of 20%. In 2025, so far, again, gold has been giving returns in excess of 12%. And hopefully, the trend will continue. But if you look at, how this recent surge has defied, the past, we did a quick analysis and we saw that to climb $500 increments in the past, it would take at least 1,700 days on an average. But the last rally, when it jumped $500 this year, was just about 210 days. So that's the speed at which gold is growing. From a 2025 full year demand and supply outlook, the expectation is that investment demand will grow simply because the risk of stagnation, geopolitical risk, geoeconomic risk, and also the risk of recession spell a positive environment for growth. Fabrication demand, which is basically jewelry demand, we think could be a little muted because record prices would mean that people reduce the quantum or the volume of purchases, and often instead of buying 22 carat, low caratages such as 18 and 14. Central banks, on the other hand, we think that elevated trade risks are likely to encourage continued buying, and mine supply is likely to stay close to 2024 set levels. Recycling may remain resistant as well due to higher prices. With that, I end my presentation and I'm happy to take questions.
Thank you so much, Sheela. That was incredibly thoughtful and very much full of a lot of information. So we did get some questions from our audience. I'm just going to go through some of them so you can hopefully just go into a little more detail on a couple of these points. You highlighted that the first quarter of 2025 saw the highest gold demand since 2016. What do you believe is driving this sustained interest, particularly in the investment segment?
Yes. So I think what has happened is until last year, a lot of European investors didn't really buy in, into bars, coins, or ETFs. We are seeing those investors come in. And that was one reason why ETF demand grew. Markets like India and China, again, we're seeing very unprecedented demand coming into the investment landscape. Whether it's bars, coins, or ETFs, again, a lot of people have actually started investing in gold rather than jewelry. And I think I would also like to think that a share of jewelry's loss has come to the investment base. And I think a lot of it has to do with, of course, the geopolitical environment, the geoeconomic risk, the tariff wars, which make gold a safe haven asset, especially from an investment perspective when equity markets have been very volatile and very unpredictable as well. So that makes gold a good diversifier, and therefore we are seeing investment demand growth.
Understood. Thank you. You showed a lot of data on gold's correlation with Indian equities and bonds, especially during market downturns. For investors looking for resilience, what does gold offer that traditional assets don't? I know you did speak a little bit about this, but if you can go into some more detail, I think that would be really helpful.
Sure. So gold is a safe haven asset, but it's also a good hedge against inflation. When there is a lot of turmoil in the markets, when markets are extremely volatile, one asset class that gives you risk-adjusted returns in the portfolio is gold, because gold doesn't have any counterparty risk. It is not subject to the vagaries of what a particular government thinks at any point in time. And as a result, gold becomes the go-to and the safe haven asset. What also one must remember is gold is like an insurance for your portfolio. And that is the most important thing that investors need to remember when they invest in gold. Like I said, equities would give you dividends, and fixed income products give you coupons or interest. But gold becomes the insurance when everything else is clashing.
Understood. Thank you for that. One of your slides showed that gold helped improve risk-adjusted returns in a hypothetical Indian portfolio. what allocation range do you typically recommend for gold in a diversified portfolio? Understand, of course, it is dependent on a lot of different things in the institutional or the individual's portfolio. But if you could just talk about some more broad things, that would be great.
Yeah, I mean, I'm not a wealth advisor, but what we would like to think is um, anywhere between 7.5 to 15%, depending on the client profile, the demography, etc., and the risk appetite. 50 going a maximum up to 15% is good enough in a portfolio.
Thank you. Helpful. um, a good one. Here's a good. Gold is often seen as less volatile than assets like oil or emerging markets. Yet some investors are concerned about its price swings. How should they think about gold's volatility in context?
So if you recall, I saw a slide where we did a comparison of gold with um, US stocks, emerging market stocks, REITs, crude oil. And we've seen that gold is definitely less volatile than any of these asset classes. Um, One thing that one must remember is, like I said, gold has no counterparty risk. And therefore, it doesn't really belong to any particular government or any particular country. Gold is available around the globe, available to trade in whichever form an investor desires. And therefore, is much less volatile. And that makes it also a safe haven asset.
Thank you. Yeah, absolutely. Um, what are some common misconceptions or perceived drawbacks about gold that you think investors should reconsider?
Yeah, so, a lot of investors think that gold doesn't give you returns. I don't think that is the case. It definitely, and we've seen this in the last few years, where it has given returns in excess of what the stock markets say. Um, but like I said, it doesn't make sense to have all your eggs in the same basket. Like you wouldn't have only equities or only debt. You need to have diversifiers which actually play the role that they're expected to play, which is cushion your portfolio when everything else is falling down. And therefore, allocation to gold makes sense. And the hypothetical portfolio that I demonstrated also shows that, the risk-adjusted returns, the volatility, all of that, uh, the volatility, of course, goes down, but the risk-adjusted returns improve with gold. So having gold in a portfolio, I think, is a no-brainer because it cannot do any harm, because it's not a volatile asset, it's a safe haven asset, and it also gives you returns, uh, just like you would expect, for any asset class.
Thank you. One question I'm sure you get a lot, and we're getting questions on this as you're speaking, to talk about a lot of people compare gold to Bitcoin, for example. And we're seeing, obviously, Bitcoin has been in the news even more than usual in the past few weeks. Can you just take us through how gold as an investment in a portfolio is different at Bitcoin? I think that would be useful for everybody.
Sure. So I wouldn't even know if I can call Bitcoin an asset class person. But
Okay.
it's a fairly new concept and no history, whereas gold has been around for centuries. Uh, we've also seen Bitcoin go through very volatile and tumultuous periods, right? Where it suddenly, surges and then also drops. So the volatility is much higher, whereas gold is not a volatile asset class at all. And what one must remember is that Bitcoin is not really regulated by anyone. Whereas if you are an investor investing in ETFs, then ETFs are regulated. Across all the markets that have ETFs, they are regulated by the local regulators. So you need a product which is from a investor perspective safe, because you would want it to be regulated so that the investors don't lose out money to any scam. And also, what we think is, if you are going to have an asset class like Bitcoin, which is very volatile, then it means that you would need to have more gold in the portfolio just to manage the volatility. So that's how I would compare gold and Bitcoin. And I think one thing that you should remember is that, the servers that run um, on the Bitcoin technology, the chips also use gold.
That's that's very interesting. I did not know that. But that's incredibly helpful way to look at things. And I think I've heard someone even compare Bitcoin to investing in a tech stock for your portfolio, as opposed to what sometimes it is marketed as this hedge, kind of like gold. But in fact, it doesn't historically, it has never really acted as gold did. I guess what this person had told me is that it acts much more like a tech stock than a hedge. Is that true? Is that something that you would agree with?
I wouldn't be able to comment on that, but what I would like to say is that uh, it's not a regulated product. If it had to be regulated, it would be a different thing. So you're taking a risk on an unregulated product, and therefore you, of course, would need to be mindful of how much you allocate. Whereas gold or gold ETFs are all regulated, so the investors' funds are actually protected to a great extent, and it's a physical asset, right? I don't know what a Bitcoin looks like. It's something conceptualized out of thin air. We don't know how and where all of it actually and how it operates. Whereas with gold, it's not that. If you want to convert your ETF into physical gold, you have the opportunity to do so. I don't think you can do anything with a Bitcoin otherwise, apart from, just use it for trading purposes. Plus, one important thing to remember is that gold has a dual role, right? As a consumption asset for jewelry and as an investment asset. Because Bitcoin is just for trading. There's no other use in terms of what it can do. But because gold has a role as a consumption asset, it's not just jewelry, it's also technology, it's also dentistry, it's medical devices. And like I said, the printed circuit boards that run, or the chips that actually run the servers used in AI and Bitcoin, all of them are using gold. So, gold actually has a use case.
Absolutely. And I know that you did discuss all the different ways that people can invest in gold. And there was a great slide on that, but I am getting a question. I guess if you can just cover that again. You mentioned ETFs, savings funds, multi-asset strategies. You mentioned gold-backed ETFs. Can you maybe talk about the difference between a gold-backed ETF and an ETF not backed by gold, and what the risks are with that?
So in India, we don't have anything, no ETF is without gold. So all ETFs by regulations have to be backed by gold. And the general unit of an ETF, so 1 unit of ETF corresponds to 0.01 gram of gold. So whichever asset management company issues the ETF have to ensure that they have adequate amount of gold or an equivalent amount of ETF gold to back the ETFs that have been issued. So
that's great to know, because I think a lot of people get nervous, and there's conspiracy theories out there that they're actually not being backed by anything. But that's an amazing point to highlight, that there is actual requirement for these. Okay, good, good to hear that.
The regulations require that this gold is stored in secure vaults, and there are audits. At least the minimum number is 2 times a year when the physical gold needs to be audited. The quality of the gold is also mandated to be LBME accredited refiners who can actually sell these bars. So they are of a certain purity, 24 karat pure gold. And so all of that is specified. So any asset management company that's regulated cannot just have any gold lying in their vaults and claim that to be backing the ETF. It has to be of a certain denomination, like kilobars, and LBMA certified refiners can actually sell these to the asset managers. So all ETFs have to be backed by gold. But what happens is for an ETF, for an investor who's buying an ETF, they need to have an electronic or a broking account. Now, we have a lot of investors in India who don't have a broking account. So, in order to ensure that they have access to ETFs, a product was created called a gold savings fund. It's also called a gold fund of fund because it's just a wrapper on the gold ETF. And you could subscribe to these without having a broking account. So you can access the same ETF with no broking account, in short. And a multi-asset fund, on the other hand, is a product which comprises equity, debt, and a precious metal commodity such as gold or silver. And by regulation, the minimum allocation to these three asset classes has to be 10%. When it comes to the precious metal commodity like gold, it has to be basically gold ETFs.
That's incredibly helpful. Thank you so much, Sheela. And one last question. I know you did cover Outlook a little bit, but of course, no one has a crystal ball in this business or really any business. But looking ahead to the rest of 2025, what's your outlook for gold given the global uncertainties that we're seeing, macroeconomic trends, and the potential for central bank activity?
So you answered half my question, half your question already.
Well, you're welcome. Just kidding.
I mean, the macroeconomic and geoeconomic uncertainty means that gold is looked upon definitely as a safe haven asset.
Yep.
But more importantly is, gold in which form, right? So, like we think jewelry demand could be muted because high prices mean that a lot of investors don't allocate so much to jewelry. But because of its nature as a safe haven asset and hedge against inflation, as an insurance for your portfolio, the investment demand is likely to be good because, all these geopolitical events are actually proving to be a tailwind for gold. And central banks, again, a lot of them are moving away from the dollar, and the only asset class in which they can actually then build their reserves is gold. So we are seeing that, for example, the Indian Central Bank, which is called the Reserve Bank of India, was amongst the largest purchasers of gold last year. It bought 77 tons. This year, we started off to a good start. The Reserve Bank of India bought about 2.5 tons already. And hopefully, the trend will continue because now the Reserve Bank of India's reserves in gold are 12%. Until a few years ago, they were just about 7 to 8%. But we've seen in the last 3 or 4 years, IBI has been one of the larger buyers, and forex reserves in US dollars are lesser, whereas the share has been taken by gold, which is now at about 12%.
Thank you for that. Sheela, thank you so much for spending so much time with us today. This has been incredibly helpful, again, and very, very timely. And what we will be doing, we will send out this presentation that Sheela used for our webinar to everyone who registered for this webinar. And Sheela's contact information will also be available if you do have any questions about gold that wasn't covered in this presentation, or if you want to be able to talk to her about how to invest in gold or absolutely anything else that your gold needs need. So, Sheela, again, thank you. We're so honored to have you here today.
Thank you for inviting me. Thank you.
Thank you.